which are actually, or it could be actually long-term in nature, which are never realized, and they're realized only when the business shuts down. Deposits with statutory authorities, electricity deposits, telephone deposits, all of this could be quite sizable, and those are realized only when the business shuts down. So that fixed working capital always has to be financed. It will never ever be in cash. So that's something which is critical and needs to be carefully addressed. The other, of course, creative nature which Satyam taught us is bank reconciliation now is the most important audit exercise. Earlier on it was done by the junior most article clerk, now I think it's done by the senior most partner. To ensure that at least the fixed deposit certificates are critical. If the checks issued and not presented are actually viable, the checks deposited not clear and actually being deposited and cleared in the near future. And this is not, because sometimes you do find the companies issue a lot of checks, just conveniently keep them in the drawer, and they never actually issue. And after the year end, they reverse all of this. This is again to manage your net current assets or your gross current assets. Some of this creative accounting does take place. Net debt. This is something one has to be very careful about. Is not so much what is stated or what is not. So in terms of net debt, one has to be conscious about capital creditors. Capital creditors are not working capital creditors. They are sometimes parked creditors, but these are actually non-operating creditors. And from a lender point of view, he's not just worried about the amount of debt. He's also worried about the constituents of debt. What is going to be repaid when? And the most disturbing question for a lender is, what's the level of haircut he's taking? Because the haircut meaning, what's the level of he has to let go? That he lets go 20 rupees of the 100, so that he hopes to make 80 over a period of time. And that haircut tends to change as the circumstances change. So he's also critical about the waterfall. The waterfall is the repayment of the debt over a period of time. What is the money expected to come in? And all companies try and show a ballooning amount after 5 years. With everybody knowing after 5 years we'll deal with the problem after 5 years. All I need is the money today. So it's very important to look at the waterfall, the level of haircut, the constituents of debt is critical, and to ensure that all the elements related to debt, the interest, the penalties, all which are now are actually being charged. The other element which is one of the greatest concerns in the restructuring environment is the high degree of discomfort whether all liabilities and commitments have actually been recorded for or disclosed. Some which could not, because provisioning policies could be aggressive and not provided for. Sometimes when you look at financial statements which are mid-year, is because of the soft close, and sometimes by omission or deliberate or otherwise, accrual of all expenses may not have been made. All liabilities to authorities, including tax liabilities, sometimes are not provided for. Issues are challenged. Employee liabilities are not provided for. And some off-balance sheet items which are of note. One is warranty costs, and warranty costs impact various businesses. If you look at auto, and others, where you have warranty, and companies tend to account for warranty costs as incurred rather than provide for the same. The second is rehabilitation costs. Again, in the infrastructure sector, mining sector, you dig a hole in the ground today, you require to fill it up. So the amount of money required to fill up that hole, you need to provide for it today. The third is securitization, particularly securitization with recourse. That happens in the financing sector. Microfinance is another key way where they try and get further monies through securitization. And if it's securitization with recourse, be mindful that the company has to make good that money. So it's a potential liability. So apart from warranty costs, rehabilitation, securitization, the other element, particularly in the real estate sector, is liabilities of subsidies. You may have it in law, you may have it in tax, that the company, the subsidies, liabilities are separate and independent of the holding company. But we know that some of these vehicles, the project vehicles, are created only to facilitate a particular project. But the ultimate liability does involve on the holding company because of various other transaction documents. And those liabilities, if they're parked in the operating company, the subsidy companies, and you don't look at them, it's a whole you will find out tomorrow. And finally, apart from this, is one which I forgot, is the breach of covenants. Breach of covenants with lenders. Again, companies sometimes conveniently or inconveniently tend to forget the all the asks and all the demands of the lenders. They believe that they will sometimes optimistically, unfortunately, that they will be able to restructure the debt. So some of the interest, the compounded interest, some of them, the company does not account for it, believing that when the restructuring takes place, they will get this concession. So concessions are recorded upfront before they are committed to. One has to be cautious and ensure that all this is provided for. One is not trying to be derogatory, but one has to try and identify all potential liabilities. And then it's a possible discussion just to come to what is the true nature of the liability and what's the true amount. But it's important to start first with a full disclosure. Then everybody's on the same page. The integration issues are critical, particularly from a corporate investor point of view. In synergies, one critical thing is the revenue trap. It happens in BPO sector, it happens in some of the other sectors as well, where you expect that if I acquire this business, it's a very good complement of my services. I'm providing services A, B, and C to critical client Mr. X, whereas the business I'm going to acquire is providing services D and E to critical client X. And together we'll be able to provide a whole suite of services to critical client X. And that way we'll be able to expand our revenues, expand our margins, and expand our footprint with the customer. That's a very nice thought. It's a very great opportunity. But think about how the customer would say it. Mr. X is going to get extremely uncomfortable when he finds that 5 of his service lines is now dependent. Not previously he thought he's dependent on 2 people, now it's on 1. And perhaps one of the first things he's going to do is find an alternate supplier. And then what happens, unfortunately, in that situation, he moves those services which are actually most profitable. And he'll end up actually losing out because of this integration rather than benefiting from the integration. I hope I've been clear. The second is, therefore, when you have these common customers, again it leads to problems. Because if you have differing credit terms in terms of business with customers, customers tend to find those terms which are most advantageous to them. And the company then tends to lose out. So these negative synergies have to be identified upfront, apart from the obvious ones which are there. In a transition service agreement, what is that is, like we say, there is a carve-out. The expectation is that whoever is the owner of the business today would continue to provide certain services and facilities till the acquirer, the buyer, is able to replicate those services and facilities somewhere else. So it's for the short term. Normally it's for a year, maximum for a year or maybe a year and a half, depending on the terms. One has to be cautious that the terms remain the same. And it's always advised that whoever the acquirer tries and transitions that as soon as possible. So some of these transition services are very critical. And it could then be used as a lever by the seller whenever there's any negotiation of the agreement, and use this to his advantage. So always this is like a Damocles sword over the buyer. So earlier it's released, the better, not on his head. The other matters which are important is one is related parties. And related parties, we know in India, everybody is related. The problem is our financial statements shows a very limited disclosure of relatives. I think Sharad was the one who advised me that the mama's son is not a relative under the Companies Act. Yeah, thank God. And he could be someone who's most closest to you. So one has to be very, to try and find related parties. Fortunately, we are very good at that. In the sense we find who, therefore these conversations help you to find. But humor apart, this is very useful. Because when you understand who the true related parties are, you can actually find out who the critical service providers are. Because in a restructured environment, you have possibility of agreements being oral or verbal, so nothing's written. Second, it's possible that if the company is under stress, there is a subsidy given to some of these services and products. So the true nature of those charges are not reflected in the profit and loss account. And as soon as the transaction happens, you find the prices go up. And because of these issues, it's important that related party is critical. And third element which you find is circular transactions. Again, to increase revenues, it's possible. We found in one situation where Coke was purchased, Coke was sold. And fortunately, they didn't do it to the same related party, but it was within the related party group, as we know in India. The other critical element is human resources. In a restructuring environment, it's sad and unfortunate, but key employees tend to leave. And then to fill those key positions, there are two costs. One is the replacement cost, which is a significant amount or one-time cost, and then the continuous cost. And this continuous cost tends to be higher than what it is today. Whenever you try and refill key positions, the cost tends to be much more. And then the other element is the employee liabilities. Again, companies are wary of providing for all of them. Leave encashment still you find provisions not being made. Gratuity to large extent is disclosed. But some of the other benefits which are given to employees, one has to be cautious that all of it is provided for. Labor union can be quite aggressive in their agreements, and then retention of key elements is important. Tax, to this August audience, I suppose tax would be something which is a given. I do know that tax is a very emotional topic in India. It brings out the best and the worst in us. In a restructuring environment, what is critical from a tax point of view is overall is one of these benefits. The benefits, as we understand, some are given to the company and some are given to the business. And depending on what is the nature of the transaction, one has to be very cautious about will those benefits continue. And apart from those benefits continuing, that's the first hurdle. The second hurdle is the company continuing to comply with all the conditions required to ensure that the benefits continue. And you always find that something which is most nonsensical, which is the most troublesome. But all of them need to be fulfilled because to get those benefits is a challenge by itself. And the next dimension is all the liabilities. Again, the generic principles. If it's an indirect tax liability, it tends to attach itself to the unit. If it's a direct tax liability, it tends to attach itself to the assessing of the company. So if again you buy a business, you may say that you're not impacted by the direct taxes, but you're definitely impacted by the indirect taxes. So have all liabilities being disclosed. And one has to be again mindful on the other side. As a due diligence provider, sometimes when clients or anybody asks us what is the total exposure, we tend to be overcautious. We love to talk about not just the tax amount, then we add the interest amount. And we're very keen to add all the penalty. And we love to, shall I say, put the fear of God into the client by saying the penalty can go from 100 to 300%. And then you put down 300% liability and the deal is gone. But one has to be therefore pragmatic and therefore very conscientious tax providers provide what is a probable level of risk, what's a possible level of risk, or what's a remote level of risk. Put down all the elements. Put down, the penalty in India, it's possible to get it waived if one pays the tax and interest. This is the level of interest which we expect to be charged. And that pragmatic solution is what is critical. So that the bill, again, is able to, someone is able to make a well-informed decision rather than an ill-informed decision. That's from a tax point of view. That brings me close to the end of this session. The way to present findings, again, this is again from my practical experience so far. One is, don't just raise the issues, find the solutions, present the solutions. Second, particularly when one talks about tax or law or some of the other complexity in business, keep the language simple. We are not English experts. The less we go, in a roundabout manner, the more direct we are, the better it could be. And finally, to focus on the material issues. Sometimes due diligence providers, when they find an issue, get emotionally attached to it. And they get very hurt when the client then takes a commercial right and says, okay, fine, we'll deal with it. And he continuously harps on it. Therefore, sometimes one has to stand back and realize that some issues, there's something called a commercial override. A commercial override means whoever the investor says, okay, I understand the risk. I've taken it, I've absorbed it, and I believe the value of the business, and I will not address it any other way. I will ride with it. That's the commercial override. And you as a professional or whoever is providing diligence needs to understand that fine, not to get too emotionally attached. to the issues you have to find and focus on the material ones. So to conclude, to summarize what we went through, diligence, as we say, is not as glamorous as deal making. It's an artist's marathon exercise, grueling, requires a lot of stamina. In an environment of restructuring environment, the due diligence process, one has to be pragmatic and quite solution focused. Third, you need to anticipate and be appreciative of all the stakeholders. We talked about a strategic investor, a lender, a private equity investor, the company, the bankers, all the diligence providers, and the employees and shareholders. And fourth, a critical element in a restructuring environment in India, you find that it's because of three reasons why a company goes through a bit of stress or distress. Three main reasons. One is because of corporate misgovernance. Corporate misgovernance, very rare there's a solution. If there's corporate misgovernance, it's better you stay away. The second would be some issues in the business model. Because of current times, the business model may not be aligned to what's happening in the business or market today. It's possible to correct the business model to some extent. If it's a well-established business, it becomes a bit challenging because in today's disruptive environment, then it's possible to become the business is disrupted. But the business model can be corrected, but to a lesser extent. But it's possible. The third, apart from corporate misgovernance, the business model, third, where restructuring happens and which is possible, is because of cash flow management or mismanagement. Because of various issues, the company has working capital challenges, and that's why it's a bit of trouble today. The business is sound, the promoters are sound, there's good ethical practices, the corporate governance model is sound. The business model will make money, it has made money earlier. It's only going through a bit of aberration right now because of certain issues with customers or suppliers or on certain product pricing or whatever. It's possible to restructure and regenerate and revive the value in the business. As the principle goes, there are man-made problems, and for every man-made problem, there is a man-made solution. The trick is to find it. Thank you. I shall remain respectful of your time. I know that we have crossed it, but if there are any immediate questions, we will take it.
One question, like while doing due diligence, companies having ADR, GDR, or foreign shareholders or ECBs, to what extent we should dig it out in due diligence report, the law aspects and governance aspects?
It's
we have to do it in due diligence in a very short time, So how to address it and to what extent disclosures and we should do it?
That's a good question. In today's corporate world, we find that there are various forms of financing, and companies have reached out overseas to ECBs and other forms of financing. As a due diligence provider, I would not get into the corporate governance and merits of it. Your first objective should be, have I been able to quantify the total liability, including the amount which has to be repaid and the terms of repayment, and the issue where there has already been a breach of repayment. Have I been able to totally quantify, and what is the total outflow expected to repay that debt? The merits of it, you get into a side discussion in the evening over a drink or two.
I just wanted to understand what would be the functional difference in how a due diligence is conducted vis-a-vis say a forensic audit. Is it like one is prior to the fraud, one is after the fraud, or is there some real differentiation?
So whether a due diligence would identify fraud, that is a challenging question, and in India it remains a challenge. We have seen that if something management wants to bury, it will stay buried. The best of forensic investigators, the best of auditors, the best of reviewers, if top management wants to stay buried, it will stay buried. Once you take over the business, the skeletons come out in the first 6 months. If they don't come out in the first 6 months, then you also let it bury till you sell the business. Due diligence, unfortunately, will not identify a fraud. If it comes out, it picks it up, it's possible. We have found certain issues because you look for fictitious sales. You are looking for liabilities not provided for. The mindset is to trust but verify. So there is a heightened degree of skepticism in the way you look at it. So you will look out for it. Your focus is not fraud. If you during the course of diligence, as an experience, you realize that the quality of information is weak, that you find that the corporate and government structure is weak, the kind of answers you're getting is not the way, then it's your responsibility to advise the client that you need to do a detailed investigation. And then the forensic team is involved. There are two elements of the forensic work. One is to carry out a background check on the promoters and key managers to understand what are their ethical values, are they got any side business. In one business we found, it was not the CFO, not the CEO, but the chief people officer. His wife had a business to the side, and that was the route being used to siphon off money. You would never look at HR, right? HR you always find to be the most ethical and perhaps the ones, but through this chief people officer's wife in a side business is how the route was being used. But then fortunately our forensic team found it. And therefore you do a background check of the key management, and then you do a forensic audit. But don't do a forensic audit, I would advise, of all elements of the business. If you still believe the corporate governance and overall the business model is right, on certain key elements, if the sales are an issue, you do a forensic audit or investigation only on sales, on customers. Or if purchase is an issue, then you look at purchase and vendors only. Because you send a forensic team, they can get very excited. And then they can go into everything. And then everything becomes an issue. Okay. I will be here for teams.
During the break, please. Yeah.
So I'll be happy to talk to all of you.
Thank you.
Thank you, sir. It's my privilege to give a vote of thanks to none other than Mr.